Hi everyone, this is Rohit from Lifestyle Mastery, and I'm excited to have Clay Norris, who's a general partner at Outlaw and a founder of Confluence VC, known for pioneering narrative capital, leveraging media to build venture scale. Clay's fund is redefining early stage investing with audience first insights and high signal capital. Welcome to the show, Clay.
Good to be here. Appreciate you having me.
Awesome. Before we talk about the newsletter and the fund, how did you get your start in venture capital, and what early decisions had shaped the way you operate today now?
Yeah, I'll give you the quick elevator pitch. So I got really lucky right out of school, so right out of undergrad. I had interned at an accelerator that then ended up spinning up a fund. I'd interned there for a couple summers. When I graduated, the associate was spinning off. They were looking for somebody to fill in from her seat. They luckily chose me. And I think that was good for a lot of reasons. But I think the first day on the job, I realized how little I actually knew about venture, like the actual job that I was supposed to do. I had very rough parameters of like what the job entailed. And then it was up to me to kind of fill in the blanks. So that job, it was a $10 million venture fund based in Charlotte, North Carolina, without a whole lot of playbook to follow. And so I think that the combination of those three things really influenced a lot of my future career decisions. But that started this idea that I needed to build my own playbook. And so that was like the genesis of Confluence, which I'm sure we'll talk about later. But then also I was realizing that in order to see the best deals, you had to be constantly talking to other co-investors and other people that are in the same seat as yourself that are looking at similar types of companies. And I think there are creative ways to do that without necessarily being in the same city as those folks. Like, I'm not a big believer in this idea of traditional networking where you're just gonna like find people you can do business with at cocktail parties. Like, I actually have a very negative feeling towards that. Like, I think it's a huge waste of time. The best relationships that I've built and the people that I've actually been able to share deals with and continue to work with over and over and over again on the investor side, it's people that I've met online where like I'll reach out to them, they reach out to me, they have like really thoughtful questions, or like there's a reason for us to talk. And you build a relationship that way. I think being in Charlotte to start my career kind of forced me to have that line of thinking, rather than just relying on the fact that I'm in like a more major city and I should just be talking to people that I can like grab coffee with or like meet with in person. And so I think that expanded my coverage. But yeah, that was my start in venture. I mean, that was 7 years ago at this point. I've compounded on that idea, built up the business, and met a lot of interesting people just using that approach.
Interesting. And before the call, we were talking about podcast and newsletters, and I've been a big fan of Jason Calacanis and Harry Stebbings and others. I've been doing this podcast for some time, but I'm a big fan of Confluence Weekly. I do make sure I read it every day, and you were ahead of the curve when it came to building an audience before you became a general partner. So, what's the most important moment when you realized that this content flywheel is the fund, and there are a lot of other GPs who are also following the same formula now?
Yeah, I mean, I'd be lying if I said that the idea was to build up an audience and then parlay that audience into a fund or something larger. I mean, I think originally when I started Confluence, I was using it as a vehicle for me to share my own thoughts and learning. I stuck with it, and I think the more you stick with it, I think different opportunities just kind of arise, or you're at least able to look at things a little bit more clearly. But I think, I mean, if people were starting out today like building an audience, I think first you need to establish that you're actually interested in the audience. I think a lot of people are interested in creating content for said audience. I think a lot of people are just pressured in this idea that they have to constantly be like creating on the internet like really low quality information that nobody cares about. I think you trade your reputation every time you put out bad content.
Yeah.
I mean, a lot of the benefit that I've gotten from my business has come in the last couple years. And I think that only happens if I stick with it for 5+ years. But for me, I think I think the funnel for Confluence is a little bit different, where like the audience creates different opportunities, and I've been able to leverage those opportunities in prior career or prior roles on the investment side. I like have met interesting people on the GP side, founder side, LP side, and it's acted as a source of deal flow. I think now the idea is to parlay that into my own vehicle where I can do the same thing, but actually own more of the upside and the carry. But trying to think of what else I can tell you about audience building. That's kind of high level. Does that make sense?
Yeah, no, absolutely it does. I actually went into a rabbit hole where I think you published an article about your newsletter in 2024 where you talked about different business model and how you growing your newsletter subscribers. So that was very interesting, and you also mentioned in your recent publication and even on Twitter where you mentioned that narrative is the new capital. So where do first time general partners go wrong when they're trying to build their own narrative, and how should they fix it? How should they go about building that sort of narrative?
Yeah, I think narratives come from reinforcement of a simple idea. I think, again, like I think there's huge benefits just to sticking with something over and over and over again. I mean, for us, we originally started the newsletter and we were sharing things once a week. It seems like people were liking it, so then we graduated to doing it 5 times a week, just because we felt like we had something interesting to say. We were like creating content for a very specific audience. I think that's created a lot of trust with, again, like a very small group of people that have us in their inbox every single morning and are essentially using us to get the news on what matters within the venture world or private investor world. I think if people are starting today and they want to craft some type of narrative, I think they have to understand first how long it takes to actually have that, to actually have the power to craft that narrative. I mean, everything worth doing takes time. And I think that's something that I probably discounted when I was just starting. But I think also like why it's so important today is because with all the new tools that have been built over the last, call it 3 to 5 years, I think it's never been easier to start a company, but it's never been harder to scale a company. And I think that's why you're kind of seeing like the skill set evolve of a founder. It's like not necessarily just like a builder, somebody that could take something from 0 to 1. I think I'm not going to say that has all gotten commoditized, but it's undoubtedly gotten easier to create something and take it from 0 to 1. But it's a lot harder to actually scale something from 1 to N, and actually create like a movement around it or create sustainable revenue, customers, talent, you name it. I think having a built-in audience or something where you can be the one crafting that narrative and creating hype around what you're building and get people to get involved, whether that's like, I mean, they could just be a follower of you if you're like building an audience, sharing the updates in public. It could create different talent pipelines for you, where like at the time that you're scaling, you start needing smart and qualified people to work in different roles within the organization. I mean, it could also parlay itself into customers or potential capital. I think having an audience and having the ability to craft a narrative where people can kind of follow along with the journey, I think it just does become a superpower. That doesn't necessarily just apply to founders. I think it also applies to GPs. Like people require more and more proof of work. And so I think all of that kind of plays in this idea of narrative capital.
Got it. And when it comes to narrative capital, are there any GPs or any VC funds which you really admire and you would want to give out examples to emerging managers that they would want to look up to or emulate?
Yeah, I think there's a few that I kind of have tried to emulate a bit. I mean, I think one is Julian Shapiro. I think really highly of that guy. I mean, he's been writing online. He's a growth expert, probably top 1% in the world, 0.01% of the world at what he does. He grows companies and has for a decade plus now. And he has a fund that's built on top of that. Rex Woodbury at Daybreak, I think he's done a really good job of creating a relatively large Substack, parlay that into a fund. I believe he just raised $30 million for it. Packy McCormick and Not Boring. I mean, he's probably the most notable. Nick Milanovic at the FinTech Fund, if anybody's heard of This Week in FinTech, that's also Nick. There's a few others. I mean, those are just a few that are coming to mind that have kind of laid the groundwork for this new idea of like converting attention online into an investment vehicle.
Yeah, super interesting because Nick has been a previous guest on the podcast, and he used to do this week in fintech events in London as well. So I met him in person, and I love those events in this week in fintech in London. In fact, it happens in Bangalore and all across the world. So yeah, I think he's doing a great job. You've written that how LPs are backing familiar fund brands, and what advice would you give to upcoming managers, emerging managers trying to break through that fundraising, because it's been difficult in the last 2 years for emerging managers to raise funding, especially for the new funds.
Yeah, I mean, we've written about this a little bit in the past, but I think if you look over the last 2 to 3 years, there's a pitch book visual that I can probably link back to. 70% of all capital that's gone to the asset class of venture, it's gone to the top 20 names.
Yeah.
So like this whole idea of like flight to quality has essentially turned these 20 names into asset managers and not necessarily venture managers. And so I think LPs, at least at the institutional level, are voting with their dollars that they would prefer familiarity rather than novelty. So I think any advice to a new manager, I mean, I'm going through this right now, it's to qualify your LP base. I think you should just realize like an institutional investor, for a number of reasons, is probably not the right fit for a fund one. I think being able to qualify your LP base, like most fund ones are going to start with either high net worth individuals or small single family offices. You're going to be wrangling 250K, like 100K to like 500K checks. You need to have the ability to qualify those people and just spend time with them, accelerate the process of building trust with them. I think that's a way better use of time than trying to convince somebody that's at, call it like $1 billion institutional fund to come in as an LP. I think like it's a lot more realistic to track down smaller checks and then just prove your fund one, because any fund one is a proof of concept fund, prove returns with that, and then build a relationship with people at the institutional levels. Then you can come back to them in fund two when it's more realistic. But that's something that I wish I would have known earlier.
Got it. And obviously, you've been a VC before, but especially with the new fund, how would you think about portfolio construction? Do you think it makes sense to be concentrated, especially in the fund one that you're trying to raise?
Yeah, I've thought about this a lot. I mean, I've somewhat conflicting thoughts because I see the benefits of both having a concentrated portfolio and also having like a little bit more diversified portfolio. I think I chose, at least for a fund one, I chose a little bit more diversified because anything early stage, I think it's just really hard. Like every check that you write, if you have a concentrated portfolio of say like 10 to 15 positions in your fund, I think there's so much downside risk to every check that you write. And I think especially at pre-seed and seed, there's just too much to uncover about a business to have that much conviction. That's why I think you see most pre-seed and seed funds, they have relatively similar portfolio construction where they aim for 35 to call it like 45 positions. You try to spread out some of that risk where you have a better chance to have a fund returner versus like a smaller fund that's targeting like 10 positions and then even like 2 of those go south. Like it's just harder to explain that to your LP base. I think that's why you also see some of these growth stage or private equity style funds have more concentrated positions. But at least that's how I've approached it. So try to invest in 35 to 40 companies. I think also like you have to kind of match the strategy to what you plan on doing beyond the check.
Right.
And so I know there's a lot of fund managers out there now that you try to compete on like a service component where you want to act as like some type of partner, or like outsourced like outsourced service partner for the companies you work with. I think that works easier when you have a smaller group of companies to manage. I think trying to do that for 40 plus positions becomes a lot more challenging. And then when you start stacking fees on top of each other, it becomes like borderline impossible without bringing in other GPs or other people on the team. And so I think these are all things you need to think about when you're building out a portfolio construction model. But in terms of just like selection, I think there's a reason that a lot of these pre-seed and seed funds opt for like the 35 to 45 number.
And what are your thoughts about reserves? Does it make sense to keep some allocation for reserves, or would you want to double down and just invest in the first one and think about reservation and reserve capital for the next one?
Yeah, I mean, for me, I have a relatively low reserve ratio, compared to others. I think the reason for doing that is because I would, again, prefer to save as much capital as possible for shots on goal rather than playing like the game of like which companies should then deserve more.
Yeah.
I think you also have a little bit more flexibility when you can co-invest and double down on some of these through SPVs rather than through the fund. And so I don't know if my approach is similar to a lot of other seed investors. I mean, everybody has different opinions on this. Like some people want to reserve like 30 to 40% of capital, write down more into the winners.
Yeah.
But at least for me, for fund one, like I'm trying to get as many quality shots on goal as possible into really curated companies. And I don't want to sacrifice some of the capital that goes to work into that strategy by like focusing on a reserve strategy for a smaller handful of companies.
Got it. And Clay, you earlier mentioned that mega funds are just asset managers, and but how do you see VC evolving for early stage operators over the next 10 years or so?
In terms of multi-stage funds?
Yes, that's right. Yeah, I mean, do you see that specialization coming in funds, or would you see multi-stage funds? Yeah, I mean, you've had big funds like Thrive and all also getting into like a Tiger Capital also getting into seed and pre-seed. But do you see that sort of change going to happen in the next couple of years?
Yeah, I mean, I think I know a lot of people don't like the idea of multi-stage funds entering into seed investing and just bidding up on, and they essentially dictate the price and they're willing to pay a lot more than like smaller funds are willing to pay. I don't know. I think the way that I am seeing it on my end, like I've written about this, that a lot of these funds that have graduated to become multi-billion-dollar enterprises, like it doesn't make sense for them to really play at seed. If you're managing $2 billion, like even writing like a $2 to $3 million check just doesn't move the needle. And so instead, at least what I'm seeing, like I don't know if this is the same with some of the other readers or listeners, it seems like a lot of these funds have created their own fund of funds program or like quasi fund investing programs where they will come in as LPs to the next group of emerging managers, and that's how they get coverage for pre-seed and seed investments. They come in as an LP, they essentially win over information rights to the portfolio companies of these other managers, and they kind of harvest that information so that they can come in and write more meaningful checks or preempt the companies that are breaking out from those portfolios. I think that's a genius approach if you have the capital to run it. like they'll still do one-off seed investments, but it just seems like more of their focus is on these growth stage deals where they can write more meaningful checks, get more meaningful company ownership, um, and kind of have their seed and pre-seed coverage be done through LP commitments.
And so just want to follow up on that because I'm seeing a lot of founders also running their own funds. We've just had Imad Akund, who's the CEO of Mercury, also launching like a $26 million fund. But what are your thoughts on operators or founders running their own syndicates or SPVs or on their own funds? Does it make sense for them to run their own fund, or do you think only VC should be focused on that?
Yeah, I mean, I think it's great. I think that, just from my own experience, it seems like founders have way better deal flow and access to other founders than traditional venture investors do, whether venture investors want to admit that or not. And so I think not every founder probably warrants a fund. Like, I think there's going to be pushback from the board of like questioning whether they're spending the right amount of time on the actual company versus like managing a fund on top of their day job. But in terms of access and finding interesting people and picking, I think that like picking and when if the equation or like the job of being a venture investor, it's what finding, picking, winning, supporting, exiting. I mean, of the first three of those, so finding, picking, winning, like these founder-led funds absolutely have an advantage. Like, it's not like they have to convince other founders to take their money. I think other founders want to work with people that have actually seen scale firsthand, have grown really meaningful companies, can act as a thought partner, and also like been in the seat of a founder. I think can be a lot more relatable than somebody that's just a pure financier on the venture side. Again, I don't know if it's appropriate for every founder to have a venture firm, but I mean, for the handful that warrant it or have the goals to have, I mean, I think it absolutely makes sense, and I wouldn't be shocked if we see more of these.
Interesting, because a lot of founders do report to like a board or investors, but even on a fund, they need to speak with LPs. But it's going to be interesting going forward. Since we're seeing a lot of companies being private, and how founders are able to balance both the acts. But you've also written that proprietary deal flow is like a myth. But how do you go about winning competitive deals in a world where everyone sees the same decks?
Yeah, I mean, I think at the end of the day, like the best founders choose their cap table, not the inverse anymore. I don't know if that was the case 10, 15 years ago, but it seems like that's the case today. So I think you have to compete on something else, like in order for those founders to find you. I think and it's hard, I mean, that's why you kind of see everybody competing on like growing an audience, growing a brand, or like some of these venture firms that are layering on different service components so that they can essentially pitch the services or the audience or the brand or whatever else they're building on the side. They can pitch that as like some type of value to the companies to why they should pick them. I kind of have my own thoughts about all of those approaches. I don't know if proprietary deal flow is necessarily a myth, because I think there are firms that do seem to see more than most. But I think seeing a deal is different than winning a deal. And so I think winning a deal really does come down to having a reason for the founder to choose you over any of the other similar size funds as you.
Correct. And obviously I want to talk about AI, but do you think AI is like the new creator economy when it comes to herd mentality, where a lot of VCs are investing to AI first companies, or do you think there's going to be a staying power at least at the seat level?
I think it's a good question. I mean, I think there are probably other people that spend more time on it than me that have a much better opinion. I mean, I think now I'm still relatively early in my career, but I've seen boom cycles, I've seen bust cycles. I mean, I remember creator economy, everybody saying that was going to be the future of venture investing, same with Web3, same with like even fintech for a time there. And I think everything that seems to get overblown in the short term has negative ramifications over the long term. I think we're already kind of seeing this. Like over the last few years, there's some of these AI first companies or companies like brand themselves as AI based businesses that I don't know if they stick around or they become like household names. I don't know. I think it depends on when you get in, like anything. But I just feel like a lot of these valuations that some of these companies are warranting, it becomes harder and harder to make the math work. Where a lot of this revenue also is not necessarily sticky revenue. I think there's like some reporting concerns around what actually constitutes as recurring revenue now. I think there's like a little bit of shady practices that have gone around like contracted revenue versus actual booked revenue for some of these AI first products. And I think now there's more than one example of companies that have quickly gone up and then also quickly gone down. And so I think anytime that you hear all these investors essentially saying the same thing and it doesn't become contrarian anymore, it just becomes consensus, I think that should flag something in your head where it's like, all right, like maybe the music has stopped, maybe I should like question whether or not I believe in this, because I do think that it's become a lot cloudier and just harder to find really quality companies that are AI first businesses that are also priced appropriately, where you don't feel like you're essentially the last money in before it's overfunded.
Right, and I've been in a SaaS world for at least 10 years now, but I'm seeing there's a bit of a pushback when it comes to the earlier days used to be seat-based pricing. Now you're looking at usage-based pricing, but especially when it comes to SaaS or earlier models, do you think the old VC fund playbook is dead? And where do you think the VC world is going to go now? Do you think the 10-15 year cycle for building a fund is going to stick around or not?
Yeah, I don't know. I think I have conflicting thoughts on this too. I think there are some people that believe we're only moving to a usage-based pricing model or a usage-based world where everybody just pays based on output. I don't know if I'd necessarily agree with that. I think that the companies of the future will probably have like some type of combination. If you're familiar with Clay, the data enrichment tool, I think they have a great playbook to follow where the bulk of their revenue is still subscription revenue for access to Clay. And then every time that you enrich a profile or like you enrich a row for the data tables, you'll use credits, which are that's layered onto the subscription revenue. So I feel like it's like a combination of that. Because I think, I don't know, only relying on recurring revenue, I mean, you are leaving money on the table if you don't have some type of usage-based product to go along with it. If the product actually has healthy usage, which is also like another variable that you need to factor in. But if it has healthy usage and users are using it as part of their core workflow, I think you want to capitalize on that usage aside from just the recurring billing that you're getting. And so if people are looking for playbooks to follow, I think clay.com is probably the best example that I can give.
Yeah, no, absolutely. I use it every day and I love it because, especially when it comes to go-to-market, it's really important to build those sort of workflows. So love that, and we'll put that in the show notes. Especially when it comes to funds like 20-minute VC from Harry Stebbings, or this week in fintech, where Nick runs the fund and the newsletter, and Confluence VC is all about Clay Norris, right? So how do you balance being a personality-driven fund, and how do you separate the brand from the personal brand from the fund when it looks at expanding going forward?
Yeah, I think it's a good question. I mean, I think people that know me will probably tell you, like, my personality is not to try to put myself first. I think unfortunately like Confluence has kind of become that where it's like attached to me and it's like Clay's thing. But I think the way that I kind of look at it is I mean, I didn't make Outlaw, like I didn't name it after myself. I didn't want to name it like Clay Capital, Norris Capital, whatever else.
Yeah.
I wanted to make it more of an institution where you can essentially have maybe on the content side of the house, if that becomes personality driven, where like people are reading what I'm putting out on the content side because it's my name attached to it, that's great. But if the funnel for the content business is to essentially create interesting content, to then generate interesting opportunities, and then have the investment fund capitalize on those opportunities, I think that's supposed to be separate than the content side of the house. So everything, if the funnel is to like leverage my personal brand or my personality to create top of funnel, I think actually capturing the value from that at the bottom of the funnel, I wanted that to be different and just not necessarily attached where it's like only Clay can run this, just so I can turn it into a larger institution. I think there's some limits to scale when you when you have everything, like when you become the bottleneck for everything. I don't know if that answers your question, but that's at least those are some of the thoughts going on in my head as I try to build and scale this thing.
Got it. And obviously, it's very interesting times, especially with AI, which has disrupted, a lot of business models in the last 2 years. But let's say, someone is looking to be like a general partner in next 3 to 5 years. Outside of, building an audience where you've done a fantastic job, what's the one skill they should also focus on building to be, have a career in venture capital, be like a GP going in next to 3 to 5 years?
I think having the ability to act as a router is underpriced. So whenever there's like a specific thing you need done or you need like a domain expert in XYZ area, having somebody that you can get on the phone with quickly without having to send like a bunch of cold emails or like cold outbound asking for favors, I think that's underpriced. I think that in order to do that, that takes a lot of conversations with people, and also like there needs to be some type of reciprocation where like you need to figure out ways that you can work with people and like share equal value with them and build relationships the long way. I don't know if that's necessarily a skill, but I do think that like the ability to do that, I think is going to become more and more valuable as knowledge becomes more and more commoditized.
Got it. And Clay, I quickly want to do the top three. What's your favorite business book?
I feel like there's a few. I don't want to say the generic 0 to 1. It's another good business book. Great Lessons of Human History. I don't know if that's necessarily a business book, but it's by Will and Ariel Durant. I think there's so much wisdom within, there's probably like 100-ish pages within that book, and it just gives you like high-level lessons on what these two learned studying thousands of years of humanity. I'd probably put that as one of my favorite business books for sure.
Got it. We'll put that in the show notes. And, if you could go back in time when you started Confluence and Outlaw VC, what is the one thing you would have focused on or done anything differently?
I would probably have more conversations with folks. I think I reached a point where I thought that running a business, there needed to be like more clear separation between you, your readers, your customers, whatever.
Yeah.
I think inevitably, like you will have to reach that point. I think I graduated that earlier than I would have liked. And so now I'm actually reversing that, and I'm having more one-on-one conversations with a lot of readers or like other people that I've been connected to over email, but not necessarily like having face-to-face with them or like having phone calls with them. I just think that I'm a big believer in serendipity. I think I've had a lot of lucky things in my life happen just coming out of phone calls with people. Like, it always shocked me. Like if I look back at some of the stuff that's been most impactful in my career and some people that have made the biggest differences, it's not necessarily the ones that you would think. Like sometimes it's completely random, but I think in order to increase your surface area and capitalize on some of that randomness, I think now I realize that you just need to be having more conversations and can't just rely on email or DMs. Like having conversations with people is one thing that I wish I would have done more of when I was starting out.
Totally. And do you have any favorite online tools, for example, Gmail, Slack, Zoom, ChatGPT?
Twitter, if that counts. I
Yeah.
get so much of my information from Twitter. I'm trying to think what else is like really top of mind. LinkedIn Sales Navigator is a really nerdy answer, but I think it's incredibly helpful just to build really curated lists of people based on who they are. I mean, I spend too much time within Sales Nav and Twitter. I'd say those two. I mean, I'm a big user of Notion, which again is a nerdy answer, but I like having like very clean workspaces. That's pretty much my workflow right there. Oh, and Zapier, like automating work away. I
Yeah.
just gave you 4 answers. You asked for one.
No, I love all these tools. I think because I've been to BD in partnerships, I need to use LinkedIn Sales Navigator every day. So absolutely, we'll put that in the show notes. And Clay, what's the best way people can reach out to you and know more about Confluence, VC, and Outlaw?
Twitter. So my Twitter following or my handle is Clay Norris 10. Try to post there somewhat regularly. And when I don't, when I go through like periods of not posting, it's usually because I'm just curating or rounding up the most interesting stuff that I found, and I'll put like a mega thread of those. So yeah, I would say Twitter.
Got it. We'll put that in the show notes. Clay, thank you so much for taking your time and speaking to us. I really enjoyed my conversation with you.
Of course, man. I really appreciate it. If there's anything I can ever help with, please feel free to give me a shout.
Yeah, absolutely. Thank you.
All right.